Hello, this is Ryan Webster. I'm one of the managing partners of Equity Yield Group, and this is Equity Yield Insights, where we dig into the details of multifamily investing. Whether you're an investor looking to generate passive income or an active sponsor, we aim to provide insight into the world of multifamily investing with up-to-date information on investment strategies and market trends. If you're interested in investing alongside us in one of our future projects, please visit equityyieldgroup.com and fill out our investor intake form. Welcome. Today's topic is interest rates. Now that the Fed has taken a stance to stop asset purchase, reduce its balance sheet, and increase interest rates in an effort to combat inflation, I want to discuss the impact of rate increases on multifamily investments. This is the forward yield curve provided by Chatham Financial. As you can see, the index for both 30-day SOFR and LIBOR are projected to increase by over 100 basis points in the next 12 months. Many value-add deals use bridge debt to fund the acquisition and capital improvements. When used appropriately, this is a great strategy for reducing the cost of capital on a value-add project. However, bridge loans are typically floating rate debt, and it is important to consider the impact of future rate increases on the cash flows of a project. This is a tool that we use at Equity Yield Group to calculate the impact of rate increases on the cost of our debt service, as well as calculate the impact of a rate cap. As you can see, the forward rate curve, even when capped at 50 basis points, will increase debt service cost for a project by over $1 million. Purchasing a rate cap helps mitigate the exposure to rate increases by capping the future interest rate. You can see the impact on overall project returns. A 50 basis points cap will yield 1.7% more cash flow and a 1.2% higher IRR than a 200 basis points rate cap. Another important consideration, if you're planning to use bridge debt on a project, is the forward curve's effect on proceeds at refinance. If you're including a refinance in your business plan, it is important to size the future loan with consideration to future rates. Generally, lenders have two metrics they use when sizing a loan: the loan-to-value, or LTV, and the debt service coverage ratio, or DSCR. In the debt service environment of the last 24 months, low interest rates have meant that loan proceeds have typically been constrained by loan-to-value. In times of higher interest rates, it is likely that loan proceeds will be constrained not by the loan-to-value, but by the debt service coverage ratio. Going forward, it is important to take this into consideration when sizing future loan proceeds. As you can see, a project that we looked at today sizes at a 75% loan-to-value bridge loan with a rate of 3.65%. In the future, we'll only size to 55 to 57% loan-to-value given a DSCR of 1.25. Assumptions of refi proceeds based on LTV alone will be inaccurate. As we navigate investing in a shifting debt market, remember to stick to the fundamentals, don't sacrifice quality, and be sure to include forward rate projections into your underwriting. Thank you for tuning in. If you'd like more insight into multifamily investing, please visit equityyieldgroup.com and subscribe to our newsletter.